In this video, I'm going to go through this capital gains tax topic from section 7 of the text, converting a sole trader or a partnership business into a limited company. So the issue here is that technically if a sole trader transfers assets to a limited company, you've got two separate entities involved in that transaction. The sole trader himself or herself and the new company, the limited company. And as company law has shown, a limited company is its own legal entity. So you're disposing of assets to another party. And this can give rise to a problem if the nature of those assets includes land and buildings or investments, because those assets are of the type that tend to appreciate in value. So this transaction could give rise to chargeable gains. Now, obviously, this would be quite a problem for an individual who's considering this. It would be a real, as I say here, disincentive for incorporation. So there is a tax relief available which defers the gains. Now, I think it's important to note the word defers. It doesn't eliminate the gains, unlike principal private residence relief. So there's a deferral where you can put off payment of the tax until a later date. The relief is known as incorporation relief. And in this paragraph here, I just emphasise that the relief does not permanently exempt the gains, it only delays payment. And how that is done is you value the shares which are created in the new company net of the deferred amount. So there's a calculation that is needed for amount of gain which is deferred, and whatever that amount is deducted from the value of the shares in the new company. So we'll have a look at how this whole process works. So first of all, you have to get the current value or the fair value of all assets and liabilities at the proposed transfer date. So again, that's worth just noting. And those are always going to be given in exams. They would be indicated in a table typically. Now, what you then must do is calculate gains on what you might call relevant assets or strictly chargeable assets. I'm just going to highlight this term here, chargeable assets. The most common examples in questions of chargeable assets are land and buildings, goodwill and investments. Current assets are not chargeable assets. Okay, so that's kind of worth noting. Current assets are not chargeable assets. So if the transfer includes these categories of assets, okay, the land and buildings, the goodwill and the investments, there's almost certainly going to be a capital gains tax issue to contend with. And you need to calculate the tax, or the gain rather, on each of these categories of assets. Then the next step is to value the shares. Okay, and what you need to look at is what assets you transferred and how they were paid. So often in questions, the new business might take on all the supplier balances owed by the sole trader. It may pay a sum of money to the sole trader, or it may alternatively give a loan account to the sole trader. So the gross assets transferred and the gross value excludes cash. Okay, so I'm just going to highlight that phrase. So it's all the current assets, all the non-current assets without cash. And note that we do not take liabilities off, so it's the gross assets only. And we deduct the elements of the consideration paid by the new company to the sole trader. So these are as indicated here. And that gives us the market value of the shares. And then we're in a position to calculate the deferred portion of the gain. Okay, so we take the total gains that we got from step number 2 and multiply it by this fraction, market value of shares over gross assets taken by the company. Okay, so that's going to give a fraction of the total gains. So that you can see that the higher the market value of the shares, the greater the deferred portion of the gain. So in a transaction that is purely for shares, there would be 100% deferral. But if there is some cash or some liabilities taken over, or a loan account created in favour of the sole trader, that's going to give rise to a tax liability. And again, I've just noted here that the denominator value is just the gross assets, okay, which we had calculated back here in the earlier step. Okay. Now, as I noted earlier, this is not an exemption from tax. So whatever we calculate in step 4, that's going to be deducted from the market value of the shares when those shares are ultimately sold. That won't be an immediate issue for us to concern ourselves with, but maybe in 5 years or 10 years, the sole trader will want to sell the shares in his or her company, and we'll have to calculate the capital gains tax at that point. And the base cost of the shares will be the market value minus the deferred amount. Okay, so we have calculated in step 4 the deferred amount of the gain, and then the rest of the gains are going to be taxable. So the difference between the total gains from step 2 and the deferred gains from step 4. So we'll just have a look at one example, and then the other video that I'll do will demonstrate a worked solution from the manual of questions. So Mark Hamill has traded as a sole trader since 1st of June 77. Following advice from his accountant, he decided to transfer his sole trade or business to a limited company, MH Services Limited or MHSL, and did so on the 1st of March 2019. And his balance sheet shows the following. Now, the important thing here is the premises and goodwill are two categories of assets that are going to give rise to a tax bill, and their market values are 100,000 and 17,000. The other assets are not chargeable assets, and we note that there's cash in there of 2,000 and some suppliers and tax liabilities. So the terms of the incorporation were agreed as follows. So the company would receive all the assets other than cash of the trade, okay, and that's again a pretty standard term. We exclude cash from the transaction. MHSL will pay the liabilities of the business. So these are parts of the consideration paid by the company. So all those liabilities are going to be taken on by the company. So this is what it's paying in return for the company. It's also going to pay some shares. Now, you're told 10,000 ordinary €1 shares. That doesn't give us the value of those shares. Mark could receive 100 shares, each valued at €1 nominal value, but their actual value may be significantly higher. So you can sort of disregard any focus on these values that are indicated. We have to calculate the share value as was demonstrated above. MHSL would also create a director's loan account in favour of Mark to the value of 12,000 and would pay Mark a cash sum of 7,000. So again, we're getting shares, we're getting a loan account, we're getting a cash sum, and we're taking on liabilities. So these are the elements of the consideration paid by MHSL to Mark in return for his sole trader business. Now you're asked to calculate the CGT arising on the transfer. So first thing I did was I just calculated the gain on the chargeable assets, which are just the premises and the goodwill. So again, just to kind of maybe split the screen so that we can see these details. Okay, so just on the top half of the screen, you can see that the market value was 100,000 and 17,000 for premises and goodwill. So these are the deemed sales proceeds. Their historic price, 15,000 back in 1977, June 77. And goodwill typically has a zero starting price. It has to be created. So the gain on the buildings is 32,000 and on the goodwill is 17,000, which is a total of 49,000. Okay, now what then happens is, in return for all the assets that, other than cash, which are being transferred, various elements of consideration are being paid by the company. So we're going to calculate the value of the shares. So these are the assets being transferred. You note that we've got premises, goodwill, receivables, and inventory. We exclude cash. Okay, so exclude cash. And again, that is a standard feature of these types of questions. We exclude cash from our considerations. And how it paid for them? It took on the liabilities and the tax. it issued shares, it issued a loan account, and it issued a cash sum. So I've got the 5,000 liabilities and the 3,000 tax, the loan account of 12,000 and the cash sum of 7,000. That adds up to a total of 27,000. And we bought 125,000, so therefore the share consideration is coming in as 98,000. Okay, so that's the value of the shares in this transaction. Okay, and again, you'll note that he received 10,000 €1 shares, but they're worth 98,000. So this is the real number to be using in our calculations. Okay, so now removing the split. Okay, so we now calculate the deferred portion of the gain. Okay, so we've got our share value of 98,000 from above, and the total gains from our very first calculation were 49,650. So 49,650 by 98 out of a gross assets 125. Okay, so that's 38,926, which is going to be deferred. Okay, and the rest of the gains will now be taxable. So the amount of the gain which is now taxable is the difference between the 49,650 and the deferred amount of 38,926. Now there is a point that can be useful, and it really only applies in situations where you only receive shares and the trade liabilities are taken over. In that instance, the share consideration can be increased by the value of the trade liabilities. So while I'll note this in solutions, it tends not to be a feature in solutions. But from a tax planning perspective, it is worth emphasizing that the transaction should ideally be for shares only and trade liabilities being taken over. So I just note, if Mark transferred the business to the company solely for shares, so he didn't receive cash or director's loan account, or didn't have personal tax liabilities being paid off by the company, then you can increase the numerator by the value of the trade, genuine trade liabilities. So that would actually potentially bring you up to 100% deferred portion. That completes just this short overview, and the next video goes to the question Alfred Scott.